Good day, everybody. This is Jim Kenny, and this is the weekly market update for OptionProfessor. And as we always start out, this will be for September 21, 2018. And as we start everyone out is to remind you that past performance is not necessarily indicative of future results, and also that short-term trading and option trading does involve substantial risk of loss. It's not right for everybody. So do consult with your financial people and your own good common sense before you do anything in the markets in this area. Okay, I'd like to give you a quick update. Today is a very exciting week. We have got the Dow Jones up 66 right now, and the Nasdaq's rolled over a little bit. It's been an all-time high on the Dow and the S&P this week, so the money's really been plowing in. And it has been plowing into a couple of different areas that I had talked to you about in prior broadcasts. And some of the stuff we had been looking at and waiting on is starting to pan out quite nicely. There has been a rotation, like I talked to you about last week and the week before, out of the tech sector a bit, and basically into some other sectors, which I mentioned to you earlier. Let's take a quick look at the board here. The S&P 500 is currently at 29.35. High was 29.40. The only word of caution I have here in the short run is that it's come a long way in a short period of time. I was listening to Fox News earlier today, and they were playing the song from Sly and the Family Stone, I Want to Take You Higher. Well, that's generally not being played at the lows, so I have to be a little concerned that we are getting into a little bit of a frothy area short run. But the trends are up, and they have been up for a long time, and they are accelerating to the upside a bit, and we are into uncharted territory, because when you're into new highs, obviously there's no real technical points of resistance, and so that's why it's very difficult to make any calls for stopping or for anything else, except if you look at some indicators, like your moving averages on the 8-day, 10-day, that type of thing, and how far away you're getting from them. And also the VIX. Let's take a look at the VIX right now and see what that's telling us. The VIX is currently at 1147. The low's been 1146. So, you can see here 11 is clearly some of the lower areas. Let's look at the last 6 months and see how that 1147 area has done. Last 6 months. Here we go. Okay, as you can see on the screen, in the last 6 months, the 1145 area has been fairly close to the low. I think one time it hit about 10. But basically, this area is about as low as it's been in the last 6 months. And so from those areas, sometimes it does move out. As you can see in August, it moved up to above 16. So that was a correction, right? And then in mid-June, late June, you also had a move from the 12 area up to 20. That was a very big short-term drop. I'm not saying that's going to happen, but this is a neighborhood where it could happen. And that's why in this kind of neighborhood, people might look for hedging tactics such as covered call writing, where you can take in a premium, and if the market goes sideways or lower, you keep your stock and you keep your premium. And also you could look at the collar strategy or married puts, where you're going to take that premium on the covered call and use it to buy a put, which gives you an insurance put on the downside in case things roll over a little bit. Again, when things get overbought, as I've mentioned to you in prior broadcasts, sometimes the markets will correct. I'm going to give you a perfect example that I brought to your attention in prior broadcasts on Amazon stock. Here you see the stock went up to 2050 on its all-time high there. And I'll just see here if I can give you a little bit of an idea here. When we're going to look at the detailed quote here, and it's going to give us the 200-day moving average. When it hit 2050, right? When it hit 2050, which was not that long ago, we'll find out how long ago in about a minute here. When Amazon hit 2050 on September 4th, just a little bit ago, I was trying to bring to people's attention that the moving average on the 200-day there was in the 1500 area. So you were 500 points above the 200-day moving average. And by definition, that is extended. And so I was suggesting people investigate the covered calls up there or the collars to protect their equity. And obviously, since then, we've dropped over $100 a share. And who's to say it couldn't drop further? And because there's a lot of real estate between where we are now, even 1929 and 1577. And the bloom has come off the rose on some of the stocks. I have heard that from the high point, Facebook is down significantly, and so is Twitter, and even Google has come off about 9% off of its high. So let's take a look at Google here, because they were the one that did not show up for the Senate or congressional situation. As you can see here, it has a couple of high points at 1250, lower highs, took out that point at 1200. Right now, I would consider 1200 resistance because it was support, right? And so now if we take out 1150, then it could be a more significant drop. If we can get above 1250, then of course we're off to the races again, I think. So right now it's in a quandary here between 1150 and 1200, and whichever way it breaks might be the way to go. Let me just give you an idea on where its 200-day moving average is, because as you can see, it is gravitating back toward it. That's why it's very important to keep an eye on that 200-day and not get too excited when things get way, way overdone. 1113. So you're still $60 away, $65 away from the 200-day. So there is still real estate between here and the 200-day. The big major support obviously looks like it's at 1,000. So 1,000 is really where it's got to keep above that to keep the bullish trend, I think, intact. Long term, obviously, it can go down, go back up. I'm just talking about from a trading perspective. Okay, so other FANG stocks today, because the NASDAQ did roll over. I bet you it's pretty red ink across the board. We saw red ink on Google. We saw red ink on Amazon. Let's check the other FANG boys out and see what's going on there. Red ink on Facebook. And so basically, so what have I talked to you about that has been going pretty well and has turned around a bit? And one of the areas is the financials. And the XLF is the ETF in that area. And the XLF, I believe, is trying to bust out here pretty good. It went to 29, but the main thing is it has cleared the hurdles that it had at around 28.50. So not going crazy to the upside. That may happen later in the year after the midterm elections. My view on the midterms is that if the Republicans can retain and increase their situation, which might not be a bad way to bet because everyone's betting the other way, then we could get crazy market action at the end of the year in both stocks and interest rates, which I'm going to cover here in a little bit. But yeah, I would not step in front of a freight train here. Yes, it could pull back in the short run, but if these guys get, if the Republican guys get what they want, which is these seats, and Trump keeps cutting taxes, and he strikes a couple of deals with China and Canada and Europe, and we start getting GDP numbers above 4, this thing could go pretty crazy. And he is quite a motivational speaker, Trump, so he could really get people, and he's always talking about the stock market, so he could be getting people a little bit hot and bothered here, and they may disregard valuations and just really look towards getting in because the prices are going higher. And that could be, obviously something that could happen as we get past the midterms coming up pretty shortly. So November and December, keep your seatbelt on. It could be a very big time for the stock market and the bond market because the Fed, during times of asset bubbles, they do hike interest rates. That's historically what they've done. And to think differently now would be kind of silly. Okay, so let's just look at a couple of stocks in each sector, okay? People love this Citibank. Why do they love Citibank? Because the book to value, the price to book is about 1, and they consider that undervalued. So it's one of the stronger ones here, as you can see. I'm telling you that as well. Prior broadcast, we went up towards we peaked at 80, had a big downtrend, as all of them did, right? Big blow off in January. Now it's starting to get on the bicycle. It's got good support at 68. I would say that's pretty good support. And I would think there's some decent support at 72, which was the former high area, 72, 73. So upward away as far as Citigroup is concerned, and going back towards that 80 number or even taking it out in the fourth quarter is not off the books if in fact things progress as it looks like they're going to progress, which is in an upward direction. There's no evidence of a big downturn. There's no evidence that everything's going to fall apart. Again, the trees don't grow to the sky, but they can grow awfully high before they turn over. Another one that I saw the other day was Prudential. You know, it's a financial company, insurance company, whatever. And PRU is their symbol. And that company pays a good dividend while you're watching. Citigroup pays 240. Okay, which is not bad. You know, money market isn't 240, and bonds, you know, you have to go out a few years to get 240. Regards to Pru, though, take a look at that. Similar to Citigroup, right? Bam, 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 stuck in a range, 95, 100. Now we're trading 104. Where's the support? I say right around 100, and it's paying 350 almost, 3.5% cash flow. Look at a PE ratio of 6, according to the screen. Say on the financials is the price of the banks and the financial companies are cheap, and they are going to benefit from an economic expansion that people believe is not over yet. And so that's why the financials are popular with people. So that's why I'm giving it to you that way. Okay. The other one is there's two other ones actually. The other one is industrials. Okay. If you look at the transportation average, you know, people are saying FedEx is something to keep an eye on here because it had a big correction after its announcement of earnings and stuff because people thought, I guess they weren't as optimistic about the future as they'd like to have seen. So it thing dropped all the way down to 240. How long did it last at 240? Not very. It's already at 248. So this might be something to keep an eye on. You got rock solid support there at 240, right? You start breaking under 240, you've got a reason to be concerned. But if you don't, this thing could take out 260 in the fourth quarter if this melt up thing they're talking about occurs. Because if there's a melt up because business is picking up, the packages have to get there, right? And so there you go with FedEx. Let's take a look at the detailed quote. Where's the 200-day average? 200-day average is, let's get this thing back down here. Oop. I'll get good with this cursor at some point. All right, 246. So it's right down against it, and the 50-day is 239. Okay, so you know you got that 240 that I mentioned. That's with the 50-day, and the 200-day is 246. So obviously, you know, staying above this region is the key. So if there's value here, you would imagine this is the neighborhood to be sniffing around FedEx. And let's take a look at an ETF that I watch. And there's many ETFs out there for industrials, but I like to look at the Vanguard VIS Industrial Index. And again, once it got above 145, as I've been telling people, it did look very constructive. We're 150. Pays 1.5% almost on the yield. Has the big in there, you know, the Boeings, all the big companies, because Vanguard, when they go with their ETFs, go with the more liquid, larger companies. And you can obviously always get a prospectus from them on that if you want to pursue it. And there's many other ETFs, so I'm not suggesting this is the only one by any means. But you can see this thing, since it hit 135, has been a moneymaker, right? 135 up to 140, 140 up to 145. Now we're at 150. Could it pull back a little bit? Yes, things could pull back in the short run. But if there's going to be a melt up in November and December, I would imagine the industrials will be part of it. And there seems to be a rotation out of tech a little bit into where the valuations seem to be more reasonable, and where if there's another big leg up in the economy, this sector could do well. Another one is materials. And Vanguard also has a materials ETF, and many people do. And as an example only here, let me just give you a little detail here on the sector called materials. And they're not that far away from their moving averages, okay? Now you can see it was having trouble at 135, right? Now it's at 137. Looks like support around the lows of 130, okay? And I would imagine the moving averages are very close to where we are. So you can keep it on a short leash if you want to. And again, materials, you know, can pick up if the economy picks up, if industrial picks up. Some of the commodity markets have turned around. I'll show you that in a second. 133, 131. Okay, and we're at 137. So it's trading above both the 50 and the 200-day. The key to these markets right now is that they hold their water. In other words, we've busted out to new highs. Yes, we could correct, but we don't want to correct 10%. We're talking about a little pullback. Okay, so these things have a little pullback, fine. This thing has a 10% pullback or even an 8% pullback, that's not so fine. So anyway, keep an eye on these three sectors I mentioned. I think they look pretty good. The semiconductors, people think is a big, hook, meaning people are thinking that this thing is not going to hold its water. Only time will tell. As I showed you last week, it looked like it had an island bottom there. This is on the semiconductors, AMD and Adobe and all the rest of them, right? So anyway, you see you're at a little bottom there on the chart last week or so. That is an island, right? You see there's the prices are all above it, and then there's a little island. That can be very powerful. If it takes out 110, I think there's a lot of potential to this thing. If not, it's just a head fake. It should stop somewhere in this neighborhood and then start going down again. So this is a crunch time for the SMH. You're between 105 and 110. You start blowing out 105 and 103, then I think you can stick a fork in it. If you can get above 110, then I think it's off to the races again. So keep an eye on the semiconductors, because I think they're very much on a ledge here, and it's going to be like Missouri, the show me state here, very soon. So keep an eye on the semiconductors. Okay, the other one people were like very keen on recently is the oil. So let's take a look at the XLE, which is the sector for energy, and let's see if there's anything there. Okay, yeah, you see, it's trying to make a turn, but here's the problem: it can't get above 76. If it gets above 76, you got a little gap there at 77. I would say this thing needs to clear 78, and then you could go into a very big run up. And you know what? Giving a couple of bucks up to get the momentum behind you is not a terrible idea. Right now, it's lacking a little bit of momentum because it had the big push from 72 to 76, and now you can see it's in a little bit of a fade mode. So if you're a longer term investor, you'd like to see 78 get taken out, and then you can use 74 area or even 76 area as support. But if we can't take out 78, you can't go to 80, 82, 86, right? So people who like to play momentum, I'd use that 78 number as a number to work with on the energy sector, because a lot of people are kind of maybe front running what the energy sector is going to do. All right, let me show you now the US dollar, which I've been telling you has peaked at 97 and is rolling over. And let's see what is going on here today. And there's a couple of things I'm watching here, and I'll get to them in just moments. But again, the US dollar, can you see the peak at 97 that I talked about? Yeah. So what's it been doing since 97? It's losing altitude. Now it's in a very big area of support, 94, 93 and a half. If it takes that out, you can see underneath there's nothing left, right? So there are some people who think in the fourth quarter, when the stock market has the melt up, if it does, when interest rates start spiking, like they could. It could also be involved with the dollar dropping. One of the reasons the dollar has been going up is there's a short squeeze of dollars because people like Brazil and Turkey and Argentina, they borrow in US dollars, but they get paid in their local currency. Their income is from local currency. Well, what's their local currency been doing? It's been tanking. And where do they owe the money in? They have dollar bonds. So what do they got to do? They got to get dollars. And that's where you get the move to 97. According to what I read, that is going to unwind in the next 24 months, and that's going to be dollar pressure. That's what they tell me. As long as it stays underneath the 95, 96 area, I think you still play it for sideways to lower. You start taking out 96, you got to change your calculation. Okay, now, I was a believer that 115 was going to be the low on the euro. The euro hit 113 and change, so I was a little bit off on the low. But now it's well above. It's in the 117, I believe. So as long as we stay above 115 on the euro, I think the surprise on the euro could also be on the upside. Hard to believe, but sometimes the yen even goes up despite all their shenanigans financially. So again, sometimes it's hard to rationalize why these things happen, but that's what I'm thinking. Let's turn to interest rates. You guys are in the bond market. If you've been in bonds, you're losing money. Why are you losing money? Because interest rates are rising and your bond prices are falling. That's the game you're in. Okay. Now, if you've loaded up on bonds in the last couple of years or last 5 years or 10 years while interest rates were at zero, you're losing pretty good money. And that's not going to change overnight unless something very weird happens and interest rates start dropping, which there's no evidence of that happening either. Now, right now, the 10-year note has cleared that 3%. Remember, I've been telling you, if it gets above 3%, that's going to be very, very much indicating rates are rising a bit, but really the 310 area. Now, if you can get above this 310 area, which is the double top there, then 3.25 is in the cards. Forget about these nickel and dimes. What's the macro picture here? The macro picture here is that the economy and assets are rising and rising and rising, and the Fed knows that that can't last forever. They know that the bigger the assets grow, the more problem it's going to be when the cycle turns. They saw 1987, they saw 08, they saw 2000. They know it's a real problem if it gets away from them. So in my view, they realize that, and every time you see the S&P jumping, the Fed knows that something should be done to moderate the growth and to moderate the flow of money and things like that. And hiking interest rates or increasing the cost of borrowing is one way they temper things out. So if there is a big melt up in November, December, you probably can count on rates spiking up as well. Paul Tudor Jones was interviewed in June. He was suggesting that the long bond, the interest rates on the 10-year should be 1.5 higher than they were. That takes you above 4%. And above 4%, that's going to be an attractive alternative for people in stocks. You know, a lot of people who own stocks are above 50, 55 years old. They got a big gain and they look in the mirror. They may say to themselves, you know what? We played this game a long way. We've made a big hit. Let's move over to treasuries at 3.5, 4%, whatever we get. And let's get for sure money coming in and a little less speculating on future earnings, which is essentially what stocks are all about, speculating on future earnings. And obviously that speculation has been right on because future earnings have been rising, right? But that doesn't last forever. And that's why people may transfer money over to bonds once the yields hit a tipping point. But there you go. I told you if it was going above 3, that could be an indication of higher rates. You get above 310, 320, and that is pretty much going to be telling you the rates are going up. And again, if they win the midterms, the Republicans, and the pro-business thing starts really accelerating, and you've got a motivational speaker in the form of a president talking about stocks going higher, you don't know how high things can get because we're in uncharted territories, which means we've never been here before. So who knows if it's going to have a parabolic spike in the fourth quarter. It certainly looks like it might, and that's why talking like that is not totally out of school. But that's why put options were created as a form of a hedge. That's why collars are created, where you sell an out of the money call, which still gives you upside potential, but also you use a put underneath to make sure you have some parameter around your equity. If you need any help understanding things that I'm talking about, I invite you guys each week to give me an email. OptionProfessor@gmail.com. OptionProfessor.com. At gmail.com. And again, let me know what your question is. Let me know what your particular problem might be, and I'll be able to try to give you, some type of an opinion that you can put into your decision-making mix. Okay. All right. Let's go to a couple of commodities here. How is gold doing? GLD. Gold hit about 1160. That was the low. Okay. And gold has tried to bounce. Now, see the in November, December, because for whatever reason, this short squeeze of dollars is coming off the books as some of these things come due. Then again, the likelihood that gold could have a run up might be greater. And again, inflation. These wages, they're starting to move. If the wages really start moving, again, the Fed's going to be playing catch up with interest rates. And the gold is going to say to themselves, if the dollar's going to drop, if the Fed's worried about inflation because rates are going up, then maybe I should buy something that's at a significant discount from its high, and take a shot down here. So basically, if we can get above the 116 area, I think that would be very positive for it. And let's take a look at the moving averages, which might be your first indication that things might be turning. Obviously, that low there does look like a potential bottom, but you need more price evidence to get a good feeling for that. And the people who own gold certainly have been under pressure for a very long time. See, 112, 121, that is not a good configuration on the interest rate, on the moving averages. So the gold is still very much in a downtrend. Let's not mistake that. But could it have a rally towards the 120 area? That is possible. And what would happen there? You'd have to see the dollar go dropping. You'd have to see inflation start picking up. Both of those things potentially could occur, particularly in the next 12 to 24 months. So if your time horizon is quite a bit longer, then there could be some value down here. And again, in the last couple of years here, this 110 area has been about as far as it's dropped. So keep an eye on 110. Those lows, again, would be a good line in the sand. If it takes that out, then of course, who knows where it's going, because there's no real support underneath there for probably another 200 points. So keep an eye on that. And again, there could be value there as well. Okay, the last one is the soybean. Again, I do try to look at all the different markets here because many of you have different interests, and I have knowledge in many different areas, so I don't mind sharing that with you. So let me just try to get this thing up here and see if I can get this price up here now for you, because this thing is very, very low as well. And, maybe Trump is going to try to do something to help the farmer. If he's going to do something to help the farmer, this guy certainly could use it, right? Look at the price of soybeans. Down, 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 right? Okay. So where's the low? The low's been around 810, right? That's the low, 812. Where are we at? 844. It bounced out of there, right? Now it's pulling back a little bit, okay? If you can get this thing to get above the 850 mark, you see that's the low there in the middle of August, that would be a positive. And certainly if you can get it above 9, then it would be a very big positive, and it would open the door for the 10 area. So basically, above 850 might be a good situation. See, today's high is 849. Close above 850 would be constructive, and a close above 9 would be very constructive. Let's take a look quickly at the moving average. And you're at 863 and 961. Similar to gold. Very lousy technical picture. Very much in a downtrend. No question about it. Now the question is are you getting value here near the lows, or are you buying a dead cat bounce? Well, that's a big question. And that's why getting above some of these moving averages might be a nice thing to see before you get too excited. You can see I said somewhere around the $10 area might be an outside potential if things got cooking. Well, you see the 200 days, 960. And getting above 850 would be constructive. Well, 863 is the 50-day. So those are the two neighborhoods of resistance right now. And if you clear them, obviously that would be a good situation. Look at that volume, though. 93,000 on a 50-day basis and 56,000 on a 200-day basis. That means a lot of selling has already occurred. And when the volume dries up in a direction, it sometimes goes the other way simply because there's no volume in that direction any longer. So if the volume on the downside is all dried up, then obviously going up from there is a lot easier because the other side of the trade, the sell side, has already done the selling. And that's, again, in converse, what might happen in the short term on the stock market. A lot of people buying in on this new high, covering shorts, jumping in, getting nervous they're going to miss out on things. So a lot of buying going in here this week. Now, if that volume does not continue, and obviously people come in to do any selling, well, if the volume on the buy side is dried up, it can fall under its own weight. So again, the volume is something to keep an eye on because it gives you some idea if the side of the market that's been happening is drying up or not. And obviously, when you get huge volume, it's sometimes followed by lighter volume. And that's why the markets sometimes reverse from their highs or lows. Okay. All right. I'm going to wrap it up here right now. Again, we did cover quite a bit. Stock market, brand new highs, uncharted territories, very big uptrend basis to moving averages. The only caveat is maybe a little bit on the overbought side and a little bit on the overenthusiastic side in the short run. Again, the sectors that seem to have turned up this week are the ones that I've been watching, which is the financials and the industrials, and to a lesser extent, the materials. With regards to interest rates, we broke above 3%. If we break above 310 and 320, the upward trend of interest rates is going to be happening. The Fed will probably be making that announcement, I guess, next week on interest rates. And so that'll be happening then. Until then, what I'd like to do is invite all the listeners to give me an email at optionprofessor@gmail.com with any question or comment you might have. Or if you'd like to talk to me specifically, just leave your number on the email and I'll give you a call back. Until next week, thank you very much for tuning in to the Option Professor Weekly Market Update. And I'll be back with you next Friday on the 28th. Until then, good luck and good trading.